Hi, class. If this background doesn't wake you up, nothing will. Welcome to chapter 3. Let's go ahead and talk about a couple of things. We're going to talk about accrual versus cash accounting. That's not cruel, that's accrual. And we're also going to discuss the idea of the accounting cycle. We talked a little about posting from journals to ledgers. We're going to finish up the process, making trial balance, reading about and learning about adjusting journal entries to get to a final adjusted trial balance, which will ultimately yield our financial statements. We take the balance sheet and the income statement right from those. So let's jump over to the screen that has our PowerPoint that's going to talk about accrual versus cash-based accounting. And when we talk about accrual versus cash, when we have things that throw on the balance sheet like accounts receivable, that's an accrual basis concept. Because let's say you go out and you sell for cash. Cash in, cash out, done deal. When you get cash, it's revenue. When cash goes out, it's an expense. Very simple, very direct. But that is not GAAP. GAAP requires us to take a look, and let me go ahead and mark up the screen on this one. So we're going to go in with GAAP. And I'll go here. Okay. And we'll look at GAAP, generally accepted accounting principles. Cash in and out is cash basis. With accrual, we're going to go ahead and record some things that we don't quite expense yet. We buy an asset, we buy inventory, we buy a building. That's not expense, that's actually purchasing an asset. When we get a bill in the mail, well, we put that as accounts payable and expenses. We don't wait till we pay the bill to record the expense. We actually put the expense into our income statement as soon as we've used it up, and that proper matching concept we talked about back in chapter 1. So when we look at that, we're going to differentiate between the accrual basis, revenues are recorded when products or services are delivered, and expenses when incurred. Notice there's nothing about the cash received or the cash dispersed in that definition. It has nothing to do with the cash. But the cash basis is quite the opposite. Revenues are recorded when cash is received, and expenses are recorded when cash is paid. So why is that an important difference? Well, think about it. Let's say we had a catering business, and we got a $5,000 deposit on December 28th for a New Year's party on January 2nd. Do we put that $5,000 in December, or do we put it in January? Well, cash basis says, oh, we put that in December. We got the money, but you and I know that if there's a big storm January 2nd, or for some reason we're not able to meet the customer's need or the client's needs and provide the catering, what's going to happen? We give that $5,000 back. So that's accruals, and we have accrued revenues, and those are things that we haven't earned yet. It's not earned revenue. So we're going to have that as a liability, that $5,000 on December 31st, and come January 2nd, once we go ahead and have the party, we're going to record that $5,000 as revenue, move it from the accrued expenses, or sorry, accrued revenue, or the prepaid revenue, or prepaid expenses. We use all those terms depending on the day, but prepaid revenue or accrued revenue is going to turn into real revenue. It's going to move from the balance sheet to the income statement. And that is the way we want to track things. So that January sales is $5,000, not January sales of $0, and $5,000 is our revenue for December because we haven't earned it yet. And the same thing for expenses. What happens if we buy a whole bunch of food and stuff on December 28th, 29th, and 30th? We want to match those expenses with the revenues on January 2nd. So we know what our profitability is from that party and from our sales in January and our expenses associated with those sales in January. That is accrual accounting. In cash accounting, when you write the check, it's an expense. So you buy some food on January 1st, it's January's expense. You buy some food on December 28th, it's December's expense. And that will not give you a true picture. Now, this is not tax basis. As a tax basis person, we get a W-2. It includes the cash we received until December 31. If we get a paycheck on January 2nd or January 3rd for the last 2 weeks of December, that goes on next year's 1040 or next year's tax return. So personally, we're all cash basis taxpayers. And some businesses do pay taxes based on cash basis, and that's okay too. But you really want to understand the business. If you want to understand how, if they're profitable, you need to have that proper matching, and you need to be on the accrual basis. That's why GAAP is accrual accounting. So this just gives some example. Accrual base, $100 of insurance expenses recognized in 2019, not the $1,200 you paid, but $100 a month. Okay, so $1,100 is actually a prepaid expense, and that's sitting as an asset in the balance sheet. And we're going to go through a process of adjusting journal entries, AJEs, and we're going to take $100 out every month, move it from the balance sheet to the income statement. We will credit the asset, and we will debit the expense. And we know our credits and debits, and we'll get more practice using them. I really wanted to make sure you were comfortable with the accounting cycle and the big picture on that. So we have over here 10 steps in the accounting cycle. We've been through analyzed transactions already. We're journalizing, we're making those journal entries, debit, credit, and balance, life is good. We post into our ledgers. So post from journals to ledgers. And then we prepare an unadjusted trial balance. We talked about trial balances before, but I'm going to call it now an unadjusted trial balance because that's what it really is. We haven't adjusted in January for that catering sale. We haven't adjusted the insurance that is the obligation that maybe was sitting in December, and maybe that was December insurance, we used $100 worth. So we're going to have to go through adjusting journal entries. Number 5, we'll talk about in this chapter. And what are those adjustments? The adjustments we make are basically 2 rules associated with those adjusting journal entries. And those 2 rules, when we look at it, are an adjusting journal entry is never cash. We're going to adjust our unearned revenue to earned revenue. We're going to adjust our prepaid expenses to actual expenses. We're going to estimate or accrue our wages, wage expense. And those are all things that when you look at the picture, the big picture of things, we're going to be saying, if it's cash, that's not an adjustment, that's a transaction. I wrote a check. That's a transaction. I don't wait till January 31st to write a check, although I can write them on January 31st, and those are not adjusting journal entries. But an AJE, adjusting journal entry, is never cash. The other rule is always one balance sheet account and one income statement account. What is that? Well, exactly what it says. We're going to be transferring stuff from the balance sheet to the income statement. We're going to adjust our unearned revenue to earned revenue, our prepaid expenses to actual expenses, our estimated wages payable, which we didn't write the check on December 31st because we're writing it on January 2nd. But on December 31st, accrual accounting says, oh, we've got to record wages for December for people that did the work, even though we're not paying them until January. So we're going to have some wage expense, and we're going to have an accrual, a wages payable account to match that up. In cash basis accounting, there's no payables, there's no receivables. There's no wages payable, there's no accounts payable, there's no accounts receivable, there's no notes receivable, although there are notes that go on. But the business that we have at hand, we're going to make adjustments so we make the financial statements more readable, more accurate, and more understandable. So let's look at some of those transactions that go with that. So if we look at, so when do we recognize revenue? Well, we recognize revenue when the goods or services are provided at the amount expected to be received. Not how much we receive, but what we expect to receive. You go to a car dealership. I actually think I talked about this in the intro. You go to buy a car. When does the car dealership recognize revenue? Not when you tell the salesperson, I'm going to buy that car. Not when you sign the contract, give them a deposit. You don't record the revenue as a car dealership until that car transfers title, until the ownership changes hands. Until then, that car still belongs to the dealership. It's theirs, they own it. In the same way, the expenses associated, the cost of goods sold with that car, doesn't go over into your expenses until you sell the car. So there's revenue recognition and there's expense recognition. We recognize expenses or match expenses, and it's the matching principle we've talked about before. Same as accounting revenue, when we generate the revenue, the expenses are matched to that revenue. Now, exceptions like utilities. You don't say, well, the utilities I used for December or for January sales. Now we're not going to worry about that. We are going to worry about things like inventory. The inventory we sell in January, that's great. We're going to put it into January cost of goods sold. That's not like our car. That's not going to be in December expenses, even though we bought the car in December or November or October. So we're going to have to match our revenues with the expenses. Advertising is another exception in that you can put advertising for December and you say, well, that's for our New Year's sale and for President's Day sale and whatever else. The advertising is expensed usually as incurred. So what are the kind of adjusting entries at the end of a time period, usually the end of a month? Small businesses might be just the end of a year or end of a quarter. What are the 4 kinds of adjustments? Well, we have 2 expense adjustments and 2 revenue adjustments. We have deferrals and accruals. And another way of using the terminology is, well, we have accruals that are estimates. And we'll talk more about how those are thought about. Like that wages payable. We haven't written the check. We got a pretty good idea of what we owe our employees. Bang, put it down. Notes payable. We know pretty much how much interest is calculated to December 31. But we don't get a bill for interest. We have to record the interest expense through the time period in the current year. Because that's the interest that matches the time that we had the money loaned and we're using it. And we're going to match that and record the expense during that time period. So we determine what the current account balance equals. We determine what the current balance should be. And then we make an adjustment. So let's look at a prepaid. Prepaid expenses are assets paid for in advance of receiving their benefits. Prepaid insurance, prepaid rent, prepaid supplies inventory. So we need to move it from the balance sheet. And remember the second rule, balance sheet and income statement. We're going to move it from the balance sheet, prepaid expenses as an asset, down to the income statement, actual expenses. We'll credit the asset, reduce the asset, and debit the expense, increase the expense. And the other rule, number 1, was never cash. We're not going to do cash. So determine the current balance. Pay $2,400 for 24 months of insurance. That's $100 a month, beginning December 1st. All right. So when we pay December 1st, we record $2,400. Cash went down, credit, and prepaid insurance went up. But one asset went up, one asset went down. Our net change of assets was zip. But we had one asset going up 2,400, one asset going down. Now we got fast forward, record the expenditure. Well, okay, the expenditures are what we just talked about. $2,400 a month, $2,400. We go ahead and for the month we have prepaid insurance of $2,400 sitting on the balance sheet. We need to determine the month of December, because this is for December 1 to December 31. As of 12/31, how much insurance did we use up and how much was left? Well, we used up 100, which means 2,300 was left. So how do we do that? Go ahead and credit $100 to the asset, prepaid insurance, and we debit or left $100 to the insurance expense. That's going to immediately reduce retained earnings. So our assets go down 100, our equity goes down 100. Now, hopefully you're getting familiar with the terms, getting a little more comfortable in understanding the relationship, but we're still in balance. Our accounting equation is secure. Life is good. So we debit the expense and credit the prepaid account. Our journals are written. Now we have the ledger. We have a $100 adjustment to prepaid insurance, brings it to $2,300. And we have a $100 adjustment on the income statement for insurance expense, which totals $100. So the balance sheet will show $2,300 when all is said and done. And the income statement will show $100 worth of expense. General journal adjustment for December 31, as follows. Okay, so that's what the journals looks like. I'm sorry, journals. What the ledger looks like, the ledger pages, the T accounts on the ledger. And there's our journal entry. $100, debit the expense, credit the insurance, good form, has the date, has the description at the bottom, indents the credit, and always debits come first, even if you have multiple debits. If you buy a car and you pay a deposit, you're gonna have, well, I got the car, but I also reduced my cash and I took on a loan. So those are going to be 2 credits to 1 debit. And it's okay. It's called a compound entry, like a compound fraction. Break in multiple places. Well, if you have more than 1 debit and more than 1 credit, which is perfectly fine, that's what's going to happen. Usually on adjusting entries, you don't. You have 1 adjustment that goes with that. But when we do payroll, we'll see how that works a little bit. Depreciation. You mentioned depreciation before. How do we get our building from our asset category down into our income statement? Well, we need to record some expenses associated with that. So how do we do that? We're going to depreciate over a period of time, take a dollar amount, and instead of crediting the building itself, we're going to credit an account called accumulated depreciation. And the other side of it's going to be depreciation expense. So accumulated depreciation, and tricky term, a contra asset, because normally an asset has a debit balance, right? But this is going to be a credit balance. The credit balance is going to be reducing the asset value. So if we have a $2,400 insurance policy, we credit for 100, that's $2,300 now. If we have a building that's worth $50,000 and we take out $5,000 in depreciation, now that building is worth $45,000. So 50 to 45. But we keep 50 on the books. We have an accumulated depreciation, negative or credit, it offsets in the balance sheet, reduces the net books value of that asset by $5,000, and we have a net book value of $45,000 for that building. We'll see how that works. Straight line asset minus salvage value equals divided by the number of years or useful life. So let's say that building had 0 salvage value. At the end of 10 years, it's not going to be worth anything. It's going to be totaled. It's going to be all kinds. It's going to be used up. Or let's look better still. Let's use a car. Okay, we got a vehicle, and at the end of 10 years, cars ain't worth much. Computers aren't either. So let's take $50,000 vehicle. We've got a nice truck, and we have a useful life of 10 years. That's $5,000 a year. After year 1, accumulated depreciation is 5, and expenses 5. Year 2, accumulation depreciation is now 10, but we still have only 5 for next year's expense. Every year, we're going to have $5,000 in expense. And what's interesting is all the income statement items we will see soon go to 0. At the end of the year, revenue goes to 0. Expenses go to 0. What happens to the asset? Still there. What happens to the car? Oh, it's still there. What happens to a cash? Hopefully, it's still there. So the permanent accounts like assets, liability, and equity stay in place. The temporary accounts like revenues and expenses zero out at the end of it. So we said useful life, period of time, the asset expected to help produce revenues. That building will last, that car will last. Useful life expires as a result of wear and tear or because it no longer satisfies the needs of the business. So even though we might have a patent, and we say that's a legal limit on a patent is 20 years. In intangibles, it's called amortization, not depreciation. Amortize that for 20 years. But after 5 years, it's a new drug, a new medicine, or a new procedure that comes out, and our patent is basically worthless. It has no economic value to us. Then we've got to write it off. We've got to reduce it. But if you say, well, in the beginning, it's a 20-year legal life, but I expect to get 10 years out of it. Well, you better go ahead and amortize for 10 years, not for 20. And by the way, if you're depreciating a building or an asset, sometimes you might readjust the time period. You say, well, I thought it was going to last 10 years, but 5 years into it, it's going to actually last another 10 years. So it's going to be a total of 15 years. So we're going to make adjustments based on the new calculation, not the old. Salvage value, expected market value, or selling price at the end of its useful life. I told you the car and the building. Building may not be worth 0. Matter of fact, the building might have gone up in value. But it is totally permissible to have a building with a $0 value on your books, even though it's worth $1 million. So if you have something in downtown Charlotte 50 years ago and you paid $100,000 for it, now it's worth $1 million. By now, it's fully depreciated. You have a $100,000 building and $100,000 in accumulated depreciation. Net book value is 0. But you're saying, but it's worth $1 million. And fair market value, you would be right. But then again, who's to say? Is it $1 million, $1.2 million, 800,000, 850,000? Accountants like to hang their hat on a number. and we can hang our hat on, well, I paid $100,000 for this place, and I know I depreciated it, but legally, for tax purposes, by the way, buildings are depreciated for 39 years. So just keep that in mind. About 40 years is what the legal life, official life. And that's a lot of companies will use whatever the IRS tells them to use rather than go pure GAAP. It's only going to last me 60 years. Well, I'm going to use 39. IRS says so, and call it a day. So sometimes you have scrap value. So at the end of a life, maybe you can, the car might have $300 worth of metal in it. Residual value, what's left after you depreciate. So fast forward, $26,000 equipment, 5-year life, $8,000 at the end of 5 years, the salvage value. So 26 minus 8, what do we get? Hopefully we get 18,000. Because fast forward, expect the equipment to be worth 8,000 with 5 years, only 18,000 needs to be depreciated over the next 5 years or 60 months. So what's going to happen? At the end of 5 years, we're going to have a balance on the balance sheet worth a net book value of $8,000, which we'll have depreciated the $18,000 over those years, over those 5 years. So 26,000 minus 8, we get to 18. And then we calculate, well, they're doing it on a monthly basis, so let's do monthly, that's fine. 18,000 divided by 60 months is 300 a month. We've got 3,600 a year. Small business would probably do annual depreciation. Any larger business would do monthly depreciation. We'll do monthly, $300 a month. So what's the rule for adjusting entry? One balance sheet account, one income statement account, and never cash. This is an adjustment. We didn't write a check for depreciation. So what happens? We've got depreciation expense 300 and accumulated depreciation. We create a new account, accumulated depreciation equipment, with a credit balance where the equipment itself already has a debit balance. So there is our ledgers, and we've got the 300 and the 300 being entered. The journal entry looks pretty clean, $300 expense, actually go back up. $300 depreciation expense and $300 accumulated depreciation. The expense is debited and the credit goes to accumulated depreciation. Even though it's an asset, as I said, it's a contra asset. And we will have contra liability accounts, contra equity accounts, contra revenue accounts, a credit balance for revenue. We're gonna have a contra revenue, maybe returns and allowances, sales discounts. Those are gonna offset the sales revenue and reduce the net sales. We'll talk about that when we get there in later chapters. All right, so what just happened? We have equipment less accumulated depreciation. Our net book value of this equipment right now is $25,100. That's 3 months later, December, January, February. And then next month, another $300 will come off. That accumulated depreciation will go up to $1,200. The net book value will go down to $24,800. I did the math right. And it'll keep going up until it reaches that level that we said the salvage value was $8,000. So we have $18,000 worth of accumulated depreciation that we can take on this asset that will leave us ultimately with $8,000 of the net book value. And that's a good term to, again, be aware of. We're going to talk net book value. I want you to realize that the net book value is the value on the books. It's the asset minus accumulated depreciation. So that's what it looks like when we do depreciation. 3 months, net value, book value of $25,100 is calculated. Deferral of revenue, unearned revenue, cash received in advance. There is our $5,000 catering order. Okay. And now we have to recognize the fact that, oh, well, we're gonna record and say unearned revenue, cash received in advance for providing products and services. Let's take a look at that. Unearned consulting revenue, $3,000, but we actually earned $250 of it. There's our adjustment. So a lawyer takes a retainer for a divorce. They haven't earned that money yet. An architect takes cash for designing a house or designing a plan. I'm putting a roof on a house. I paid half down the contractor, and I gave them money and don't have a roof yet. They're working on that. They still have to get the shingles and get out there and do what they got to do. Roofing's a lot. But then our unearned revenue goes down. Our unearned revenue may be plane tickets that haven't taken up, plane fares that haven't taken off yet for an airline. Unearned revenue is the insurance revenue that has not been used by a customer from the insurance company perspective. We had prepaid insurance expense, they called it, but that was an asset. That was on our books. The insurance company has unearned insurance revenue. They have a liability, we've got the asset. Now, if the building burns down on January 2nd, we're going to get our premiums back because we're not paying for that insurance the rest of the year, at least that level. So the balance sheet will have a net of $2,750 of consulting revenue back. Income statement will show a total of $6,050 because we already had $5,800. We had another $250 from our adjusting journal entry, AJE. All right. Adjusting entry, $250. What's it look like? One balance sheet account, one income statement account, and not cash. We're debiting the unearned revenue, which is currently a liability, big ticket. We're going to reduce that by $250, and we're going to increase our consulting revenue, a credit, $250 on our income statement. All right. So let's talk about salary and wages payable. So now we got a situation, pay employees $70 a day, $350 for a 5-day week. They're paid every 2 weeks on a Friday. 12/31 is a Wednesday. We got to calculate how many days salary we need to adjust. Now, we haven't gotten a bill for the salary, but we got a pretty good idea. It's $70 times 3 days. So we've got a $210 adjustment. Looks like this: debit the expense for $210 to record the expense associated for those 3 days that we haven't paid yet, and record the salary payable, the obligation to pay. And with that obligation to pay, we're going to be in a situation saying, okay, it's on the balance sheet. I got a salary payable. It'll clear out when I write the check next week. So here's what it looks like. 210 will be recorded in salaries payable, and salary expense will be increased by 210 because we had 3 days worth of work that we needed to record. Hopefully that's making sense so far. If you have questions as we go, let me know. All right, so our balance of salary expense includes the 210. We had $1,400 until December 31, but we had that adjusting journal entry that we made December 31. Future payment of accrued expenses. All right, so we're going to accrue, we're going to estimate. Remember I used the word estimate for accrual? So again, if we go in, try to understand what we're saying. Accrual. You never get a bill for these. That interest payable. We didn't get a bill for interest on note. Mortgages, we don't get bills. Car loans, if you have them. I recommend against them, but that's another story. We'll talk someday maybe. The idea though is you're estimating the obligation. What happens if you got a trade show, December 28th, and you guys were out and spent $50,000, and everybody put it on their credit card, and you submitted the travel expense reports, and they were due by January 15th. Well, you need to estimate how much in expenses you incurred last year in this marketing endeavor, or this travel associated with the customer or whatever you were doing. So you're going to estimate that 50 grand. It might be 55 grand, it might be $45,000, but putting 50 grand is better than putting zero. So we're going to have to record something for that. So we have salaries. Next we'll reduce salaries payable. All right. So, and then what happens on January 9th, we write the check. The whole $700 goes out, but only $490 is an expense in the current year. The other 210 zeroes out the salaries payable. This is a January 9th transaction. So January 9th, we're paying the $700, but we're only recognizing in January $490 of expense because only $490 applies to the days worked in January. This 210 came back from December. Accrued revenues earned in a period that are both unrecorded and not yet received. So agreed to pay for future services. But again, there's no bill associated. But the consulting revenue, 20 days worth of services have been provided. We haven't billed it yet, but we know exactly how much we're owed, $2,700 bucks. Okay. I'm sorry, 1,800. So we're going to say receivable is 1,800, even if we haven't sent the bill yet, which we haven't, and 1,800 revenue, because we earned it in December, even though they're not paying till 10 days into January. No cash, one balance sheet account, one income statement account. Receivables, asset, consulting revenue, income statement. There we have receivables going up, and we have revenues going up. And when revenues go up, immediately our retained earnings goes up, our equity goes up, we're back in balance. 1,800 up in equity, 1,800 bucks up in assets. Accounting equation is still good. We're in good shape. And then accrued revenue at the end of one period is cash receipt in a future period. So when we get that cash later in January 10th, we're going to only recognize 10 days, 900 in January of revenue, and we're going to clear the receivable, the 1,800 that was sitting on the balance sheet on the asset, because it's no longer owed to us. We got paid. We got paid 2,700. 1,800 was for last year's services, and 900 is for this year's services. And only 900 will reflect on the income statement for January so far this year. And this is the flow to the income statement deferrals and accruals. There's a chart in the book you can see, but again, accruals are those estimates. But every one of those is one balance sheet account, one income statement account, and never cash. Getting the idea? I hope. So here's our trial balance. And then we make adjustments. We have debit and credit adjustments. And so we have $100 going into, let's see what we did here. All right, so we have 100 in insurance expense and 100 in prepaid insurance. We're reducing our prepaid insurance from 2,400 to 2,300. And we're increasing our insurance expense from 0 to 100. We're debiting the expense and crediting the prepaid. And all of these are, they better balance, 3710, 3710. Yep, we're good for that. After we take our original unadjusted trial balance, we make our adjustments, we have an adjusted trial balance. And those are the numbers we're going to be working from to create our financial statements. So what's the flow? Prepare an income statement using revenue and expenses. So we're going to, then when we want to make financials, we're going to take the net income from the income statement, statement of retained earnings, which you recognize, I sure hope you recognize. Let's go back here and remember our statement of retained earnings. Look, beginning retained earnings plus net income minus dividends, ending retained earnings. Prepare a balance sheet using asset and liability accounts and adjusted trial balance, and pull updated retained earnings balance from step 2. So we're going to use this retained earnings number down here when we're updating our balance sheet. Because ultimately, these are going to zero out. Revenue goes to 0, expenses go to 0. Retained earnings are going to keep retain the earnings. That's the name. Prepare a cash statement of cash flows for changing in cash during the period. And this is another look, if we look at our financials saying, okay, we've got our adjusted trial balance, and we yield from that, well, oh, everything beginning with a 1 happens to be an asset. Everything with 2 happens to be a liability. Everything with 3 happens to be equity, including dividends, which is a debit balance, not a credit balance. It's a contra equity account. Then we go down here and say consulting revenue, credit, and then expenses, debit, and that goes right to our income statement. So I've got my balance sheet, I've got my statement of retained earnings, and I've got my income statement. Again, the diagrams are in the book. I'm sure you've seen them by now. I hope you have. And hopefully they're starting to make more sense. Okay, closing process. Reset revenue expense to 0. Revenues goes to 0. Expenses go to 0. What we just mentioned, assets are going to stay on the books. Our building doesn't go to 0. Our inventory doesn't go to 0. We haven't sold it all. Our accounts payable, the money we owe to our vendors, doesn't go to 0. Although that would be nice. We don't have to pay them. But of course we do. We owe them the money. They're not going to say, yeah, don't worry about it. It's the end of the year. Have a good time. So we're going to go through and close out, identify accounts for closing, record and post-closing entries. Those are the zeroing out. And then that post-closing trial balance reflects revenues at 0, expenses at 0. I did mention earlier temporary and permanent accounts. Permanent accounts are our assets, liabilities, and equity. The balance sheet isn't going to zero out. The mortgage isn't going to zero out unless we just paid it off. Our vehicles and buildings aren't going to zero out. But our revenues will, our expenses will, and there's something called the income summary things close to. I'm not too worried about that. Other than, as long as you understand the concept, we're going to zero out the income statement and the balance sheet lives on. And then there's a process, credit balances and revenue to income summary, debit expenses to income summary, close income summary account to retain earnings, close dividends to retain earnings, and life is good. Okay, that's the final process. And recording the closing entries, there's an example screen you can read about in the book. But bottom line is, our income summary is all our expenses get closed, income summary, all our revenues get closed, and dividends get closed to retain earnings. Dividends are never an expense. Your own company dividends, if we pay $200 dividends, we're not going to be reducing, it's not an expense to the business. That's a distribution to owners. That's why it goes straight to equity and through retained earnings. Post-closing trial balance, permanent accounts or balances after closing. Total debits still must equal credits. And notice our post-closing trial balance. There isn't an income statement count to be seen. Those are all zeroed out. So all you have left are the assets, the liabilities, and the equity. Back to our accounting cycle again to review. We analyze the transactions, we journalize, make the journal entries, we post to our ledgers, general ledger. We make adjusting, we produce an unadjusted trial balance. Number 4, we adjust, make adjusting entries, AJEs, and post those into the accounts, make adjustments. Prepare an adjusted trial balance, prepare financial statements, number 7. Close out those closing entries, clears out revenues and expenses, and prepare a post-closing trial balance, and reverse and post. I won't worry about reversing entries here, but there's a process of that automatically reversing that you can read about if you like. We'll talk about it in financial reporting or intermediate accounting. So the idea here is there's a cycle. And again, this is done at the end of a time period. Let me talk about time periods. So we might have a year end of December 31. But if you happen to ski in the Northern Hemisphere, that's kind of a busy season. Things shouldn't slack off till March or April or May. So you might want to have a June 30 year end of your ski slope. December 31 doesn't make sense for school either. That's just after first semester in a college. So we might have a year end at June 30 or July 31. So our year end, I've been saying 12/31 all the time here. And typically for a small business, that's what we use. As an individual taxpayer, that's what we use. But a business, logically, will have their year end when they're not busy. A retailer does not want to have a 12/31 year end because that's the middle of Christmas returns. So they might wait till the end of January, the end of February, the last Saturday in January. Okay, the last Tuesday in February. Whatever they choose, and they're consistent, that's fine. But those annual time periods, they're artificial time periods, but December 31 is just one benchmark. A year end can be any date that one wants to choose. Let's talk about classifications on a balance sheet. And we're going to break this down a little bit. Current assets is separated from non-current. So current assets like receivables, like prepaid expenses, basically being used up in a year or converted to cash within a year, inventory. All of that stuff is a current asset as opposed to the long-term stuff, the plant assets, the equipment, the vehicles. By the way, land is never depreciated. Just to make you aware, buildings are appreciated, equipment is depreciated, vehicles are depreciated. Land supposedly keeps its value, but that's for accounting purposes, it does. Intangibles, those are all long-term assets. You're going to benefit for more than a year. Then current liabilities, accounts payable, you pay within a year. Mortgage payable, bonds payable are usually more than a year. You can take out a 1-year mortgage. Typically, it might be 15-year, which I encourage you to do. or 30-year if you need to. So those payables you have, non-current and current. Be careful though, every time you do a mortgage, there's a portion of that mortgage is a current liability because you're going to pay off some of the principal in the first year, and the rest, so you got a 15-year, 1 year worth is current and 14 years worth is non-current. And you, man, if the numbers are big enough, you're going to make those adjustments in your financial statements. There's a materiality consideration. If it's not material, we're not going to worry about that level of detail. But like when you talked about buying a trash can, and it's going to last for 5 years or 10 years, we don't make that an asset. We don't say, well, I'm going to depreciate my $10 trash can $1 a year. Don't waste my time. Expense it, $10, income statement, done deal. Usually a company will set a standard, might be a $300 threshold or $500 or $600. Anything you buy for under $500, expense it. Depends on the scale of the business, and usually that's okay. You might buy a $200 tablet, expense it. You might buy a $50 trash can, expense it. You might buy a $200 lamp or desk, expense it. You buy a $600 computer, we're going to depreciate that one. That's above our $500 threshold. Current assets are expected to be sold, collected, or unused within 1 year or the company's operating cycle, whichever is longer. Let me emphasize that, especially for you accounting and finance folks. Typically, you go to Kohl's, they buy clothes, they sell clothes. They buy clothes, they sell clothes. The cycle might be 3 months by the time they buy it, stock it, sell it on average. Every 3 months, they turn out their inventory. If you're making a ballistic missile submarine in New London, Connecticut, or you're Boeing and you're creating a Dreamliner down here by Charleston, it takes longer than a year to build a Dreamliner. So what's going to happen? The operating cycle is when you get the raw materials, you make what you get, and you sell it. That's the operating cycle. So the operating cycle for Boeing is actually going to be longer than it will be for Kohl's, most retailers. Typically, it's 1 year. In this class, assume, I hate to assume anything, as you know what that stands for, but assume that it's going to be 1 year, not the operating cycle, when we talk about current assets and current liabilities. Long-term investments are expected to be held for more than a year of the operating cycle. Planned assets are tangible, long-lived assets used to produce or sell products or services, machinery and equipment, buildings. Intangibles used to produce or sell products and services that lack physical form. This is a patent, is a license, a copyright, a trademark. They have value, goodwill. These are all things that are on your books, and a copyright theory is it lasts for 70 years past the life of the creator. Well, the Michael Jackson estate owns a lot of Beatles songs. Paul McCartney doesn't have rights to those songs. He can contract out and he can go ahead and buy the use of that song and pay the Michael Jackson estate who bought the song years ago, but they own it. They own it. You may realize you may not hear the song "Happy Birthday to You," "Happy Birthday to You." You don't hear that too much in a restaurant. You don't hear that very much on TV unless it's "Happy Birthday, Mr. President." But every time someone sings that song, in theory, someone's supposed to pay a fee to the owner of that copyright. That's why these restaurants are making up songs like "Happy, Happy Birthday, Happy, Happy Birthday." They're singing songs so they don't step on toes and they don't have to pay ASCAP for use of that song because they're making money off that song when somebody comes there for their birthday. And they could be sued, copyright infringement, using somebody else's intellectual property, IP it's called, intellectual property. Current liabilities due within the longer of 1 year or the company's operating cycle. The longer is there in the definition. Should have been current assets. Long-term liabilities not due within the longer of the year of the company's operating cycle. So again, longer. Equity owners' claims on the asset. So we're going to go ahead and profit margin. We got net income divided by net sales. What's our bottom line net income? So if we have, let's go over to another example here. And we're going to say we've got revenue of $100 million. We have expenses of $90 million. What's our net income? $10 million. High function math. What is our net income percentage? Net income is a percentage of revenues. What's 10 out of 100? Oh, that's 10%. So I've got a 10% net income percentage. That means for every dollar of revenue, I put 10 cents in my pocket. Walmart's is about 4%. For every dollar of sales, you put 4 cents. You say, wait a minute, I spent $2 a gallon of milk, probably cost Walmart $1. And you're saying, yep, their gross profit is $1. $2 less $1 is $1. But then the expenses of utilities, rent, marketing, legal department, accounting department, cash registers, and all the other stuff to run a business is 95 cents. So their net income, let's say 90 cents, their net income of 5 cents on $1 or 10 cents on $2, you're going to have a still 5% net income percentage. Is 10% better than 5%? It depends. A grocery store that makes 5% is pretty happy. They're usually 3 or 4%. But if Apple made 10% or 15%, they'd be disappointed. They're closer to 22, 23%. ExxonMobil, they're probably closer up to 8%. So depending on the business, depending on the industry, is what you have to worry about. All right. So net income divided by net sales. In this case, it was 100 in sales, 90 in expenses, net income of 10. Could be millions, billions, or trillions. It doesn't matter. 10 out of 100 is 10%. That's our profit margin. And the current ratio, I expect you to know, current assets divided by current liabilities. Current assets are those 1 year or less current things, an asset, 1 year or less liabilities. Basically, this is a liquidity ratio that says, well, I've got more current assets than current liabilities. I'm going to have a current ratio greater than 1. That means I'm in pretty good shape to pay my bills. My current assets are half of what my current liabilities are, 0.5. That's, how am I going to pay within a year stuff that within a year I have current assets and within a year I have liabilities a whole bunch more? I may not be in a good position to pay that. So that current ratio is a ratio you want to be cognizant of. It's in the homework. It'll be on the exams, and we'll talk some more about that. That's chapter 3. That gives you the big picture. That gives you highlights. That gives you ideas, hopefully, and insights into what we're talking about in our operations. And if you have questions, I'm at your service. And other than that, I look forward. And this is culminating week 1. Chapters 1. No, we have chapter 4 to go to, don't we? We have 2, 3, and 4 in week 1. So this is chapter 3. Hopefully you're in good shape. And hopefully you're keeping up and knowing what you got to know. And let me know if you have questions as you go. Don't forget the discussion threads. There's 1 discussion thread a week, and those are graded as well. Not heavy, but they're enough to want to make sure that you do them. I look forward to seeing you again soon. Thank you so much.